anything in particular that you would like to cover today, just in terms of kind of where we left off yesterday? And just to give you an overview, we're going to cover, more of what happens after the offer gets accepted, but we will talk about some negotiation tips, kind of what to expect in this market today. And then after your offer gets accepted, how you're protected by the contract. Looks like Jason just hopped on too. Welcome, Jason. And yeah, so we're just going to cover, really what to expect after your offer gets accepted from the very beginning to getting your keys. So anything in particular that you have questions about after talking to Jason yesterday and myself for a little bit?
Not yet. I think me and my brother have done a lot of research and talked to a good amount of like friends and families just of them buying houses recently and stuff like that. So for us, for right now, I don't have any questions, but I probably will.
Okay. Well, definitely feel free, and that's for anybody that's on here. Looks like Leslie's hopping on right now too. Feel free at any point just to ask a question. There is a little Q&A tab on the bottom there. There's also a chat. I don't always see that as we're going through it, so if you need to unmute yourself, I'll try to make it where talking's permitted. And we shouldn't have too big of a group today. We didn't promote this, and just really kept it word of mouth, and it's kind of nice to keep it small and intimate. That way we can make sure we cover as much content. Planning for about an hour. It's very likely to go about an hour and a half. This used to be a class that we taught. I think I shared with you, Danielle, that my dad's taught this for 22 years here in Ventura County. Quite a few of those years on base to many of our sailors and people who have served. And then actually it was Pacific Oaks. I think that's what they were called before, but Pacific Oaks Federal Credit Union asked my dad to teach it out in town just for those that couldn't get on base. And so he did it for a few years there. I also joined him with that at that time, but then worked for a nonprofit called BCCDC and did them every single month like clockwork there. So it was a pretty intense 8-hour session there. And the real estate portion for that was an hour and 15 minutes. But just to put it in perspective, when we would teach this class, when my dad taught them on base, it was about a 4-hour class. There's so much that's involved in the process. And the goal of this is to really empower you so that you understand and know just how to be more in the driver's seat, because this is a big decision, as we talked about. It can be very overwhelming, can be very nerve-wracking. Knowing the affordability crisis is what it's referred to here in Ventura County. It's daunting on many different levels. So our goal is to educate you, empower you, teach you as much as we can, and the more that we share with you, the quicker that you're going to know when you come across the right opportunity that this is, in fact, the home that you're looking for, and you know exactly what to do in that situation. Does that make sense? Danielle, are you still there?
Yeah, sorry, I muted myself and then I said yes, and then I had to unmute. You're good.
No worries. So I guess we'll get started. And Jason, is your mic working?
I think so. Can you hear me?
Yep, we can hear you on there. So it's up to you if you want to get your video showing on there. I believe I added you as a panelist, so I don't know if you came in through a different route than the panelist route, but either way, like I said, it's kind of a small group. So as long as you guys are good, keeping it unmuted like this, we can continue this way.
Yeah, I'm trying to figure out how to do the video thing. Is that a setting somewhere?
Probably. Well, at the bottom left, it should show, where you can show video. But I believe you came in through the link with everybody else, so you probably need another one. Do you want your video on there? I can try to send it to you. It's up to you.
Either way, whatever works for you. I could log back in if there's another link.
I think it is. I think you're on the regular general one, and then probably have to go through the Zoom. If you're okay with it, let's just continue like this, just so we don't have too much in terms of time. Great. So I guess just before getting started, just any other particular things that anybody has questions about before we roll and get to it. That's anybody on here. So we got Yvette, we got Josh, we got Leslie and Danielle. So any of you that, any questions that you want to cover today?
No, I'm ready to just get started.
Okay, let's do it. All right, so So let's go over, so if Danielle, if you're okay with it, I'm just going to continue off what the last things that we spoke about, if that works. And
Yeah.
we'll tailor this more to you. And I hope you can feel comfortable in this group. It's just so you know, for the other people that are here, Yvette, she works, she's a partner associate, as well as Josh and Leslie as well. And all good agents and good people. And you know, we do this in our training as well. So as long as you're comfortable, everything will stay confidential here. And then we do record it so that we can, you know, put it on a private link for YouTube. And then you can share that with Andrew. And then, you know, just any questions that anybody has, you know, please, this is more of trying to make sure, because sometimes there's some questions that come up that you're not thinking about and somebody else will ask. So never feel there's a dumb question. This is for anybody that's on here. The biggest thing is to make it as educational as possible. And then this is something that, you know, we can use just moving forward. Does that work?
Yeah, that works for me.
Okay, sounds good. So, you know, I haven't touched base with Jason, so not exactly sure what you guys covered, but I know, you know, kind of the first step just starting out is speaking to a loan officer or a couple loan officers. And then you submit the loan application process. And Jason, if you'd like, do you want to give just a quick overview of kind of somebody reaches out to you for the first time? What are the questions that you ask? And then, you know, what do you do from that point? You know, and typically, how long does it take to find out where somebody is today?
Yeah, so, you know, when I first start the process, you know, I first try to figure out where the prospective buyer is coming from as far as, you know, what they're looking to accomplish. Everyone comes from different angles, like as far as what they know or don't know. Sometimes they know a lot of wrong information. But in any case, you know, it first starts with trying to get an idea what they're trying to accomplish as far as what they're trying to buy and the purpose of, you know, considering even buying a house. And then, yeah, a lot of it has to, you know, the next steps is going to be figuring out, you know, what kind of payments they're looking for, what kind of home they're buying, and just get a better idea of their situation, how much money they make, how much, you know, money they have that they're looking to put towards a transaction. And from there, I could start asking, you know, the right kind of questions to know the information I'll need to get to facilitate a pre-approval. You know, and then from there, I just send out the information. And sometimes every transaction is different. We had a really good conversation. We went into, I think it was a good hour or so. We went over a couple different scenarios. And then usually what I do is, you know, send a recap email of what we spoke about as well as what we need and ultimately the next steps to move forward. And, you know, but as far as, you know, getting the, you know, getting to the point where after the, you know, where I can do the pre-approval letter, it's really from the time that I get all the items that I need to pull the, you know, take the application, pull the credit, verify the income and the ability to pay the mortgage. And, you know, that process is a good 24, 48 hours as long as I get everything. And that information I get the first time around doesn't lead to more information that I need to get to ultimately figure out what we can qualify someone at.
That's great. And then, and typically, so I know when, you know, when I kind of explain it to prospective buyers, I'll share and just say, okay, you know, Jason can ask you a few questions. Asking about debt to income is a pretty important ratio for you, correct, right? And so it's debt to income ratios. You want to run their credit report. And sometimes you get people who are hesitant in running their credit. You know, can you explain why that's important to do a full application?
Yeah, absolutely. So when it comes to credit reports and credit scores, the pricing is based on your credit score. And while you may think that you have one credit score, my credit report might actually have a different credit score, and therefore the payment and pricing could be different. So that's, you know, first reason. And kind of going a little deeper into that, the reason for that is a mortgage credit report has different algorithms and weighting involved in determining one's credit score, or, you know, that magical number that we use to assess risk, or in our case, the ability to repay the mortgage. So the higher the credit score, the lower the risk. You know, the lower the risk, the better the pricing. So first and foremost, it's important. So I know that I'm, you know, quoting the right payments based on the credit score, because it could vary greatly. someone thinks that their credit score is 800, but it's really 600. There's a huge difference. In fact, it might be the difference of getting a loan and not. So we want to make sure we're all running in the right direction when it comes to quoting payments as well as pre-approving someone. So, and the other thing too is just if there's opportunity to improve the credit score, I'm not really going to be able to help you out. Even if you give me a consumer credit report, because it's a different type of credit report, it's hard for me to really figure out how to really figure out how to improve your credit score until I pull it on my end, at which point I could also order the what if simulator and simulate, if you pay off a credit card or if you open up a new credit card, different ways to ultimately improve one's credit score.
Right, and that's actually what I was hoping you were going to hit on there. So a lot of times the big advantage, and there is no cost up front, correct, for you to run their credit and do that. It is something that's a closing cost. If they use you and close the transaction successfully,
correct,
there is a cost for it, but it's not something, if they go up front, run their credit, check it out, say it's not their time now or it's 6 months from now that they ultimately end up purchasing, there is nothing that they're paying up front to you, correct?
That's correct. Yeah, there's no upfront cost. There's a cost, but not to the consumer.
Right. And then just, this question came up just actually the other day, and I don't feel I did it justice in terms of explaining it. It's not to put you on the spot. It's just in terms of transparency, right? Sometimes people are trying to figure out, okay, so how do loan officers get paid? And I'll phrase the question the way it came up because it was a good reason for asking the question. The gentleman who brought it up mentioned how he had friends back in 2008 who made a good amount of money working on the lending side. This is pre-market crash. And a lot of the times, many of these loan officers were putting people into pretty risky loans that ultimately, the riskier it was, kind of the worse the loan, the more that loan officer got paid. You mind just sharing just a little bit about what happened with Dodd-Frank, how it changed that? And then if you can get into a little details just in full transparency in terms of how you get paid so that people know as they're looking around that it matters in terms of service, but also the protections that are in place since Dodd-Frank.
Sure, absolutely. So back in the Wild Wild West, there was no regulations as to how a loan officer gets paid. I was not a loan officer during those days. I was an underwriter, often shaking my head, wondering what is going on. I wish I was a little bit smarter to know investing wise in the stock market. But in any case, going back to your question, so back then there was no regulation. So loan officers, and especially those at more of the mortgage companies, not so much banks, but mortgage companies, they had comp plans, but they also had incentives back then they get paid more, or the pricing was higher on certain programs like the negative amortization loans. I believe they got paid more on. Again, I was not a loan officer, so I don't know for certain, but rumor has it that's part of the reason why there was so many of those bad loans is because the pricing was better. Same thing with the prepayment penalties. And ultimately the loan officers somehow had the ability by carving out more of a margin to make more income by doing those bad loans. So Dodd-Frank, basically, there was so many problems. It wasn't just how loan officers were getting paid that led to the mortgage meltdown, but they came out with a lot of different regulations that we're now governed by. As far as making sure that the buyer or borrower has the ability to pay the mortgage is huge. We want to make sure we're not giving, a gardener, that really only makes $3,000 a month, a $6,000 mortgage payment, and expecting them to, figure out how to make ends meet. It's just not putting anyone in a good position there. Obviously, there's gardeners, landscapers that could easily make that high of a mortgage payment if they have a big route or whatever. Maybe they have a big business. But in any case, going forward past Dodd-Frank, once regulations were passed to ultimately preserve the housing market and make sure it's stable to where there's not another big house of cards and financial meltdown tied specifically to the mortgage in the housing industry, lenders are now required to have different, have comp plans. And I can't make more, like most loan officers have different comp plans whether it's a bank, a credit union, mortgage company. We have a comp plan that's kind of tied towards what that bank is paying, and it's kind of market driven. for the most part. And it's paid through the yield spread of the loan itself. So there's some lenders and comp plans that have, lower pay, but better rates. And a great example is an internet-based lender where all they're doing is getting, internet-driven leads where you maybe get some sort of advertising on Facebook or online somewhere and you click on it. And next thing you know, you're basically communicating with someone who's paying money to buy that lead, usually a bank, and it goes to, a lot of it's automated, but eventually it goes to an actual human, whether they're here in the US or in a different country, they're ultimately going to be interfacing with you and possibly, giving you options to get a mortgage. And sometimes, that particular loan officer, they are probably working on a smaller comp plan, especially if they're in India or another country, than a local retail loan officer here that's not paying money for a lead. So there's just different parts and different, I guess, facets of business will determine like what a loan officer gets paid. But ultimately the consumer is not paying it directly, like out of pocket, like as a cost. The only cost that's associated out of pocket on the actual transaction that's like on the line item of a loan estimate is the origination fee, as well as the cost to get that interest rate.
Okay.
So that would be like the lender fee would be the processing underwriting fee, which, I've seen anywhere from, 1,000 to like 2,500, somewhere in that range for like the lender specific fees.
Okay. So about 1,000 to 2,500, just lender specific, not title,
Yeah.
not other closing costs, but lender specific.
Correct.
That should be about the ballpark.
Yeah, and costs are interchangeable too. So there's lenders out there that will advertise no cost,
Right.
but what they're really doing and saying is, they're going to give you a higher interest rate. It's built into the overall profit, just like the loan officer's compensation is built into the overall profit of the loan.
So any way to do a fair apples to apples comparison so that you know that you're getting a pretty competitive cost as well as rate in fairness, of comparison?
Well, when you speak to a loan officer on the phone, a loan officer could tell you, a rate, but they're actually not really contracted, obligated to give you a rate if you just do a quote, even if it's on an email, like some of the quotes I did yesterday, screenshots. That's not an obligation by any means.
Right.
That's, me saying what it is. That's what I can do. So ultimately there has to be a little bit of faith and trust for the consumer based on the person that they're getting that information from. Because ultimately the lender and loan officer are not really obligated to provide that rate until the rate is locked in.
Right.
And the rate is not locked in until they're in contract to buy a house. The loan application is submitted, and we can actually lock that interest rate. And to do that, not only do we have to be in contract, but we have to know how long of a rate lock we need to buy, because there's a cost. The longer the cost, the higher the longer the lock-in period, the higher cost for that interest rate.
Okay. So would you say it's a good idea, especially if somebody gets ready now, it gets quoted a certain rate now? Obviously the rates can change, and I know the projections look pretty good from what you've shared with me in the past in terms of the rates staying pretty competitive, for what we can see in the foreseeable future. Actually, I believe it may have been your brother Daniel who mentioned something about the Fed rate staying at close to 0%, which ironically is a good thing, but it doesn't tie it as much to interest rates as many people believe. And I know, Jason, you can, do a great job of explaining that, but, another 15, 20-minute session.
Yes.
Yeah, but to keep it moving, number one, thank you for your honesty in terms of talking about cost. Biggest thing to kind of sum it up, got rid of all the bad stuff, all the bad practices that were happening in the past. There is a reason why you want to work with somebody who has a strong reputation. And the biggest thing we can emphasize in this is trust your gut feeling. Go with who you trust. And if you feel you trust Jason, you feel you trust any loan officer out there, and you feel they're looking out for your best interest, you feel they're knowledgeable, they communicate well, you can get a hold of them when you need to, because that's really the difference maker. And a lot of times it'll be just one phone call to a bank or one phone call to somebody who issues you a letter. You feel that you've done enough to start the process, but really a whole lot hasn't been done. And more importantly, there isn't a strong communication between whoever your loan officer is and that real estate agent. And that's part of why I have Jason on here right now. I've worked with a lot of different loan officers. So now I'll give my plug of why, and I'm not saying it just because he's on here. I'm very picky about who I work with in all facets, but especially when it comes to the professionals that I'm putting my name and my reputation on. So Jason has been somebody who has been honest, who knows his subject. He's as passionate, I feel, about on the lending side as I am on the real estate side. I know he's all in. I know he cares about his clients. I know he cares about long-term business appreciation. It's not a one and done type mentality and approach. And everybody kind of has their own business model or their own business approach. So he was actually introduced to me through a friend on a hard money situation, probably about 6-7 years ago. And then I found out that, I love the fact that he started on the processing side and knowing how to put things together. So without stroking Jason's ego too much here, don't want your head to get too big, but I appreciate what Jason brings to the table. He is somebody that I do trust. And more importantly, as we talk about the market conditions, and Jason, he's even shared with me, he's like, yeah, all these other buyers coming from other agents, now they're all calling me up because their people can't get it done. Well, it's the way that he's done his business and continues to, that there is a high demand for his services in terms of what he does. And him and I both are careful about who we're working with, because we want to make sure that whoever we represent, that we can do a great job in representing them in every facet that we can. And it's not to say that Jason or myself are perfect by any means, but I know where the intentions are, and I know where that's at, as well as the other agents that are on here as well. That's the way that we do business. So it's critical that you find that, and the sooner that you do, and I don't know one person that I've sent over to you, Jason, that is, that has been worse off by talking to you up front. You've helped every single person. And the other thing that I respect is, if there is a better scenario that you know of that's available or that they hear about, you're upfront with them and say, hey, look, that's a unique program, a jumbo loan or whatever, something that somebody else has access to that is better. And, I would obviously love your business, but you point them in the right direction. And I think that speaks volumes about your integrity and who you are as well. So
Right.
That wasn't too much, was it?
I appreciate that. Yeah, and I didn't fully, I guess, answer the original question, just kind of jumping back as far as comparing between lenders. The locked loan estimate is basically the best way to compare apples to apples.
Okay.
Specifically Section A and Section B of the loan estimate, but it's really only fair if it's locked.
Right.
Because that's really a commitment. Anyone could just put what they want on that loan estimate.
Good point.
It's kind of, most loan officers, most of the bad weeds were weeded out through the regulations, but there's still some out there that might be over-promising and over.
Yep. Yeah, and I haven't heard it. I haven't heard it as much, and maybe some of it has been because I've done quite a bit with you, but I know in the past with other loan officers, and kind of the horror story that would come up is something's promised up front. You get into escrow, now you're ready to lock the rate, and it's a huge change. And
Right.
Obviously, there's certain times that we were in a pretty volatile market with the rates fluctuating quite a bit, especially when the stay-at-home order first hit. Around, I remember those two months, it was just crazy how quickly it can go up and down with the rates. And so, and that wasn't you pulling the switcheroo. That was something that was completely out of your control. But I can say just through track record, that is one thing. Whatever you're quoting on the estimate, that I don't know if you quote very conservative up front, but it's it's competitive enough where people see that it's a solid rate. But at the end of the day, it's pretty close, and that's a compliment that I hear from many buyers. So just want to share that. These are more just for any buyers that do watch this. But Andrew, when you see it in the future, I guess I'm spending more time on it because these are important questions, and it's an important part in terms of starting out. But I do want to make sure that we get into the timeline through the process and talk a little bit about negotiations and what we're seeing right now. So I guess before I jump into it, anything else you wanted to leave with that, Jason, in terms of those are out there that are looking for different loans and trying to compare and make sure that they're going the right direction with starting on the loan process?
A lot of it is really just not just the rate, but the time frame, as you know. agents, especially listing agents, they still want to close in 2 to 3 weeks, which isn't really realistic right now because of the low interest rate environment. So the main thing is just making sure it's not just that you're comfortable and confident working with the individual, but just be mindful of whatever the turn times are and how fast they're able to respond to you and your questions. If you have a hard time getting a hold of them now, like before your offer is accepted, you have like a limited window of time to get stuff done. So the best thing to do is, like, if you don't feel comfortable talking to your loan officer and asking them questions, then maybe that's not the right loan officer to be working with, because it's a complicated transaction and there's a lot of questions. Like, even if it's not even your first house that you're buying, even if it's a second or third, you should feel comfortable going to your realtor or going to the loan officer to ask them questions, whatever it may be. No question's too stupid. It's a big decision to buy a $500,000 house or whatever it is. Ask the questions, be comfortable asking them. And most importantly, right now, especially, just know what kind of timeframes are they looking at from point A to point B once like an offer is accepted to get the deal done. Obviously on a refinance, sure, work with a lender that will take 3-4 months to close a refinance. I guess not that big of a deal if you're saving some money and you're not spending too much money in interest over that extra period of time. I guess it doesn't matter as long as it doesn't make you go crazy, and as long as you get the rate that they promised you, great. But on a purchase, time is important.
Absolutely. All right. Well, thank you, Jason. No, great point. Timing is critical. Communication is critical. I popped up. Can you guys see on the share screen the escrow timeline? Is that showing for everybody?
Yes.
Awesome. So, and I guess before I jump into it, any other questions, Danielle or anybody else, just in terms of what we covered so far?
I'm good for right now.
Awesome. All right. So some of the key highlights, what this is this is an escrow timeline. And I'm going to talk about some keywords that you're also going to hear through the process, escrow being one of them. Contingency is another important word. And contingency means good faith excuse out of the contract. These are your protections. So just kind of a quick overview is we're going to talk about timing, how critical timing is with on a standard 30-day. We are seeing more that are 40 to 45 days, but usually when you're competing in a multiple offer situation, which is very common today. So a lot of the way that I'm going to explain this is what's relevant to today, what we're seeing in the marketplace. And today it's low inventory, low interest rates, high buyer demand. Not everything is flying off the shelves, but the good ones are going. The properties that look more HGTV, you're going to hear that quite a bit as well. They have the look that you see on HGTV, and just be careful watching it. I know my wife loves to watch HGTV, and by the time I get home and I see it, at least when I was going into the office every day, I'd come home and my bed, you got to change that. No more real estate HGTV. We've been doing it all day. But there's a certain perception or look of the modern color schemes, the modern things that are out there that when you see a home, we already know as professionals and agents when we walk into the property, okay, this one's going to go quick and it's priced well and it's likely to be a multiple offer situation. So when we talk about the time frames, we're going to talk about it in regards to today's market, which is pretty competitive for buyers. But with it being, as much as I share the reality of the situation, which can feel overwhelming or maybe convince you that maybe now isn't the time, I also want to make sure that I share with you that every buyer who is committed to the process and doing it the right way, doing their homework up front, which you're doing right now, Danielle, as well as everybody else that's on here, you do it the right way up front and you work with the right people. There isn't one person that has wanted to buy a home that was committed to it that hasn't found the right home for them at the best terms that they could get in this point of the market. So a lot of, as you're investigating and looking and trying to figure out, this is where we spend a lot of time coaching our clients, is you think in your mind, okay, I want this house, detached home, white picket fence in a particular neighborhood or a particular location. And, I know my comfort zone or my budget is right around here, but this is what I want over here. And you think that initially, and I'm not saying that you can't get that, but what most buyers come to find is they buy the best property that's available for what they can afford at that given point in time in the market. And so sometimes, you're thinking, well, it's low inventory. Why would I try to do that right now? The biggest incentive for buyers right now is these extremely low interest rates. You can stretch your dollar, your purchasing power so much more today than you could when the rates were up almost 1% to 2% higher, definitely more than 1% higher a year, 2 years ago. So even though there may have been a little bit more selection, and to be honest, inventory has never been flooded really over the last, I'd say, 5 to 7 years. And we can talk about the cycles of real estate, and we could talk about the mindset. So these are all just kind of different areas that we're going to cover. But the biggest thing that I want to emphasize is we want buyers who want to become homeowners to be successful, keep their home, and create wealth. That's one of the primary incentives and reasons to get into the real estate market, to try to purchase a home, especially in Southern California, where you can do very well. And for a lot of people, this is their biggest investment vehicle. So we take a lot of pride in making sure we educate the right way and not just put somebody into a house just because, hey, that's all that was available. That was all that I could afford. And I really don't want to miss out on anything else. So I'm just going to settle for this property. It's not how we work, but we will educate you so that you aren't ultra concerned and hesitant that because in this market, in this kind of competitive market, if we go and we see something and then we want to come back and see it again, more than likely that property is already gone. More than likely, if it was that good that you were interested in this second look, the property's gone. And it's going to be out of reach. Where say you saw it, and at some situations, it's worth it to see it the first day it hits the market. And what starts to happen because of the low inventory is, we'll start getting messages from our clients that say, hey, this home just came out. I want to see it ASAP. Let's check it out because I see everything's moving. And when I see it, and I see in the agent remarks, and this is a common strategy of what you see today because the inventory is so tight and there is competition, is it'll say on the agent remarks, that's something that we can only see as real estate agents, that we're collecting offers for 7 days or 5 days, or we'll present offers on this date. When I see that, and I have a client who's motivated, who's ready, who knows what they want, and they see a house and they love it, I'm not going to be, sometimes we'll show it on the first day, but more times than not, I'll say, you know what, let's check on day 5. Because at that point in time, it's not going to be our offer that we come in first day, we get excited, we write a full price offer, we can try to do a short expiration. And these are some strategies of what we do to effectively get our buyers to get their offer accepted. But we do that, and they've already given us notice they're going to collect offers for 7 days. Well, now our offer could be used to just create that multiple offer situation. So instead of being the one that really doesn't have the best shot up front, in that situation, I'm going to recommend, hopefully I have some type of relationship with that listing agent. If not, I'm going to start trying to build rapport with that agent and reach out to them, start speaking to them. I'll ask them, I'm not going to hound them every day, but by about day 5, I'm going to call them up and say, hey, do you have any offers in hand? Typically, if they do, they're going to say, yes, I do. Then they don't, more times than not, they're not going to share with you what they have. But our jobs as agents is to try to find ways without just saying, okay, well, what's your highest offer? Without directly saying it, that typically will get shot down. We got to ask some other questions. So I share that just in terms of how we go see properties. And then there's some new regulations and guidelines in place today that typically require that you have a pre-approval letter as well as that PEAP form before going and showing the home. So that all makes sense. And I know, Danielle, we covered some of that yesterday.
Yeah.
Okay, cool. All right, so let's go into the process now. We're going to go into writing an offer. So we're going to say, Danielle, that you're going to be the buyer in this situation. You see a house that you love, right? Let's just throw it out there. We'll say it's a nice, we'll go with the condo townhouse. We'll just say a 2-bedroom, 2 masters, somewhere in a good spot in Camarillo, North Oxnard. And we find a place. And it fits everything that you're looking for. The asking price, we'll just throw a number out there, is at $490,000 is what they're asking. It looks like it's priced well based on comps, and those are some of the things we're going to look at. We're not looking at the Zestimate, even though everybody's inclined to say, oh, Zestimate says it's 510, or Zestimate says it's only 420. Do you think we can write 420 and get our offer accepted? So we see this property at 490. And this is completely just role playing, playing it out just to try to educate on the situation. You see the home, it just hit the market. You think it's the right fit. What's your natural inclination, Danielle, in terms of writing an offer? What price or what things would you want to know before you write your offer?
HOA fees or like Belarus fees?
Great question. So HOA fees or Melrose fees. Awesome. Any other questions that you would have?
Can't think off the top of my head.
Okay. No, those are two great questions, especially for condo, townhouse. So as we talked about with HOA fees, first to start with that. HOA fees, what's pretty common right now is between about $300 to $450 a month. That's pretty common everywhere. You find less than 300 a month, that's a pretty low HOA. If you see it like 130, usually the less that you're paying, the less that they're offering in terms of what they're going to do for you. But as we said yesterday, quick rule of thumb is about every $100 in HOA is roughly about $10,000 a purchase price. So if you were pre-approved up to 490 and there's a $300 HOA, this house may be out of our budget. Now, if you were pre-approved at 520 and you found this one at 490, you know, it's probably close. You still may be on the high side. So what we would want to do is we call Jason up and say, hey, Jason, this is the property we're interested in. And they're asking 490. The HOA is 325 a month. He'll ask me, are there any Melrose there? Unless he can see it already because he has access as well, and he can check it out and say, no, I don't see any Melrose. But these are the questions that we will ask, and a lot of times the data sheet on the MLS will say this property has Melrose, or sometimes it's just knowledge that we have, like River Park in Oxnard, North Oxnard. A lot of those look great price-wise because of the Melrose. Well, if you add Melrose, property tax, this is just a quick rough estimate, rough numbers. I'm all about not shortcuts, but just being able to quickly calculate things so it helps think, clear up our thought process. Typically, homes in River Park are off by about 100,000 of what you can qualify for a single-family detached home out in the regular market. So if you see something there at 450, you're probably able to buy, if you can afford that payment at 450 with the Melrose, with the HOAs, and they actually typically have 2 HOAs. Most people aren't aware of that. So when you go to sell a home in River Park, a lot of times you're paying almost $1,200 up front. Sometimes it's 2 or 3 different HOAs that you have to pay for the transfer fee on all of those. And so many people are like, oh my gosh, I got to pay $1,200 just to transfer my HOA documents, my CC&Rs. These are your rules and so forth. So great question in terms of the HOAs. We want to first make sure with Jason that we qualify for it. And even though you may already have a pre-approval, which I don't know if you're exactly at that process, but say you have a pre-approval in hand, well, we're going to ask Jason to do something a little further. It's called a DU approval, direct underwriter approval. Many agents don't recommend that their clients go this extensive, and many loan officers don't necessarily provide it for you as quickly as Jason, will do for our clients. But when he issues me that direct underwriter approval, it's got a lot more detail in there. It talks about your debt to income ratios, in which we want to keep typically under about 44%, which means that's a healthy loan for what you can qualify for. It talks about your income, it talks about your credit scores, it talks about if there's any red flags that they saw when they submitted your information. So it's further along in the process. That's why it's critical that you get all that info over to Jason as quickly as possible, so that when we do come across what could be the home, that we have all our ducks in a row. And then when we present that offer, if we are in a multiple offer situation, or say we're the first one to put it together, my job and our jobs as agent is to try to package it in a way that when an agent receives it on the listing side, they see it. It's not just an offer that says the amount that they want. They can tell, okay, this person's got, number one, most important, great job stability in, with the whole COVID-19 and what's happened this year. So that's critical. What type of job, what kind of field are they in? And it's getting much better, so that, hopefully shouldn't be an issue for many people. But how strong of a job is it? And we want to package that. So we write the offer. We typically have some type of intro email. On the intro email, it's going to show what your strengths are, income, why you love this particular property, why this location makes the most sense for you, why they should choose you. And if we can do it and they're not collecting offers for 7 days, and I ask the agent, hey, and they respond, we're presenting them as soon as they come in. My client just is looking for the right buyer who can get the job done. And then so I'm going to try to communicate that over the phone. I'm going to put it in email when we send the offer. I'm going to typically send it with your proof of funds. So that's like bank account summaries, could be 401ks, it could be stocks, it could be whatever we're going to liquidate and use as your cash to close. So that number that gets quoted from Jason, we're going to package that together. And then it's just going to be a nicely tailored professional email that shows that you're working with professionals and that we're all committed to getting this done. So, you know, speaking from experience on the listing side, when I see something come in like that, they're already steps ahead, even if the offers are neck and neck. I'm going to give about, and this is what I used to teach in the office that I managed in the past, is 50% of it is the strength of the buyer. This isn't to minimize how important you are and to be qualified and to be strong. But the other 50% of it is who's the agent I'm working with on the other side. And as a listing agent, I'm literally interviewing who do I want to work with, right? Not just strength of buyer is key, but do I have somebody who's going to be agreeable on the other side, or are they going to fight me tooth and nail in every situation? Is it somebody who knows their stuff? Are they professional? Do they know how to get through challenges and issues? I remember when my dad used to teach this, he's like, look, with all the things that have to go right for a successful closed transaction in California for real estate, it's almost as complicated as having a baby, right? I mean, it's a miracle babies being born. And I don't mean to make real estate sound as complicated, but you'll see if you do this enough times, there's typically never the exact same scenario twice, but there's a lot of common key things, and that's what this escrow time period is geared to cover, to kind of highlight those things. But you know, as you can see, it's more than just writing an offer, sending it over, and then we hope and pray that we get our offer accepted. There's a methodical process that I'm trying to share some of that up front so that you know. So some of the things you can work on is, you know, speaking with Andrew and just thinking, okay, what are some of our strengths, or what are the things we're looking for, and why do we want to buy there, right? Why is this important to us to own a home right now? And start working on that, and start kind of typing up a letter or an email when you get some time. So say you come across a perfect property tomorrow, you're not trying to scramble and throw something together. So a little bit of homework on your part, but it helps make the process good. And just so you know, we kind of have our own templates of what we work with that we've refined over the year, that we see certain approaches are more effective than other approaches. Does that make sense?
Yeah, I'd love to see those templates.
Awesome.
To help out.
Sounds good. Okay, well, we'll keep it moving. So getting back to the initial scenario. So property's priced at $490. You find out from Jason you can qualify. It's within your budget in terms of where you want to be on your monthly payment. So it fits the bill. It's everything that you're looking for, just hit the market. It's 2 days on the market, was the earliest that we were able to see. I called the agent. He says no offers in hand at this time, but we've had a few other showings. It looks like it's getting a lot of activity. You see the place. What type of offer do you want to present? They're asking $490. What do you want to write? And there's no wrong answer right now. You're not going to be judged or criticized by any means. Just throw whatever out there you want, and then share with me why you picked that particular number.
I would say 485,
Okay.
if just more of like a little bit under, but not too much where it's like insulting them of what they put it up as.
Okay, so 45, a little under. Now let's just say, and the big question I'll ask my buyer is this a gotta have house? Like, will you be kicking yourself if we don't get it? Or is this house you're okay if we miss it, and we're just trying to negotiate and see if we can save $5,000?
Yeah, I think for this, like, especially for like the first few, for just like trying to get our feet wet and figuring out if that's the house, or, you know, giving it a chance to see if we could get it lower.
Right. Okay. No, it's a great approach. So let's just say, so you put in the offer at 485. Okay, that's what we ultimately decide to do. And I'm going to come back to it and bring up a couple points, because it's a perfect situation in terms of offering 485. And then there's some other creative things we can do as well. But now let's flip it. I'm gonna have you flip hats, because this is also important in terms of trying to package something where, you know, you get your offer accepted. A lot of this and what we're trying to teach with this process, it's more strategy than anything. And there's a reason why you can be successful and win, as we talked about, win at the game of real estate. So if you're a seller now, You put your house up for sale. You know 490 is a good value. You know that there's been comps that have sold higher than that, but you want to get good activity. And you have it on the market for 2 days. You get an offer at 485 that gives you a short expiration. It says 24 hours, give us a response. How do you respond to that offer at 485?
If I've only put it up for, you said 2 days?
2 days on the market. You know you're priced well. You know it's a number that you're getting appraised value at that or higher. How would you respond now? Because now you're the seller. So your job's to make every penny that you can. On the buying side, it's to save every penny. And one of the things we didn't talk about yet, but it's on the agency disclosure form, which by state law, it's important that that's the first form we go over. As soon as you decide, who it is that you want to represent you, you want to speak to that agent, and they should go over that. And what it says is that your agent has a fiduciary duty to look out for your financial best interests. So my job is to literally save you every penny that we can and protect those interests, because this is what I'm trained to do. And I have a statutory duty by state law to look out for that financial best interest. So on the buying side, it's typically to get you the best deal possible and save you every penny that we can. On the listing side, my job is to make that seller every penny that we can. So every dollar matters when you're selling. And not that it doesn't matter on buying, but the thing to keep in perspective on purchasing is when you buy a house and you're financing a majority of it, over the 30 years, every $5,000 is roughly $30 a month in your payment. So if you already know at 490 that's within your sweet spot, right? Let's just throw a random number. I'll just say 2,500 a month. It's probably going to be different than that, but let's just say 2,500 a month based on your money down, what the current interest rates are. And let's just say that number hypothetically is in your comfort zone. If you're a seller and you get an offer 2 days on the market, how would you respond to it knowing that you're in a strong seller's market? What would you do?
Maybe mention a price of a house that sold recently and that you're currently not going to go down that price.
Okay, so that's an option. So you have 3 options as a seller. We can accept it at 485, we can counter it, or we can reject it, right? Now, I like your thought process of not trying to insult them and come in too low, right? That's a great thought process. In terms of trying to win, personally, I wouldn't come in 5,000 under. I would either come to, even as backwards as this may seem, I'd either come in at 10 under, or I'd come in at asking or higher than asking. And the reason why I say that is I'm trying to put the pressure now on the seller to commit to your offer and lock you up. So one of the most important things to understand in terms of winning in real estate is the second that seller accepts your offer and signs off on it and says, yes, you are our buyer, they can't get out. That sellers, they're committed to you as long as you can perform and close all the way through the process, through a 30-day escrow. As you see the timeline here, you see 0. 0 is day 0, right? And that's the day that the seller and buyer have a meeting of the minds and they agree on all the terms of the contract. So what's typically going to happen, exactly what you said, you would point out that there were other higher sales. Normally, they're not going to be as nice to you and do that and actually even say that. They're hoping that we've done our research, that we already know of the other sales in the area, and we want to show them that we're ready to go and that we know and we see the value in this home. So a lot of times we think that, okay, well, they'll just counter us back. I've done it before where we've written at asking price, at a full price offer, short expiration. This was at almost 700,000. It was like 690. Within, I put a really short expiration on it. They didn't even acknowledge it, number one. Number two, I think after like 24 hours, they had 6 offers in hand. So once they had their 6 offers, now we're not even in contention. And we wrote that very first one. We came in on the very first day it hit the market. We see it, we love it. I talked to the agent, I asked her, how are you going to handle it? She tells me I'm going to present them right away. If we get the right offer, we're going with it. So we come in strong, full price, not 5 or 10 under, full price. And it's at a high purchase price where we're thinking, okay, we're going to have a legitimate shot. We didn't have a home to sell, which is called a contingency. So we didn't have to sell a home to buy a home. And if you're in that position, in purchasing a home where you don't have to sell something, you're already a step up versus somebody who has to sell a home because there's risk on the sale of that home and the money they need from there to purchase this. It's a domino. If that one doesn't work, this one doesn't work. So you're already going to look better as a non-contingent buyer. So, long story short, we don't even get a counter back. It ended up going, I think, 30 or 40 over. No counter even comes back to us, even though when I spoke to the agent, she shared with me that she was going to present it right away. They weren't trying to hold on to the offers. And I'm not going to say, I don't want you to think that agents are going to bluff like that, but sometimes, that's part of how things work out. So the biggest thing is when you get your crack at it, especially in this kind of market, you always want to put your best foot forward. And typically, and because I know we helped out some buyers just not too long ago, just hit the market. They actually had 2 other offers. The other 2 offers came in like 5 and 10 under. It was at 600,000, so they were at like 590-ish, right about there. We came in, and we could have came in at 6. We came in at 610 because we knew it was going to be a multiple offer situation. It already was, but we knew it could get stupid quick. And so we wrote 10 over their ask, and we put a short expiration on it. By that night, they accepted our offer. It appraised no issue at 610,000. That's just also part of knowing the market of what's happening today and the type of property. And this was an HGTV property all the way. Everything completely updated. Had the quartz, I believe it was quartz. If it wasn't quartz, it was granite, but grays, I mean, beautiful. Completely redone, closer to the beach property, in a better location than even if you just go across the street on the other side. It's not as desirable as these newer ones. So it's all case by case. It's not every property that you see that you're going to write at asking or higher than asking, or and maybe in some of them you can try to come in a little bit under ask, but it depends on the key number you want to look at is timing, days on market. So if you see something that's been overpriced and has been sitting on the market now for 30, 60, 90 days, now we can try to work. Now we can see if, hey, maybe we can come 10, 15K under this one, maybe even further than that, depending on where we're seeing comps, and especially if we see it and we know the market. So it's all case by case. You have some of those that are just going right away quick, and you got to come and swinging hard if you're going to have any kind of chance at it. Then you got others that are on the market that may need a little bit more work. And these are some of the conversations we want to have a little bit going through the process is, I would ask you, Danielle, are you looking to move into a move-in ready property, or are you open to something that has popcorn ceilings, right? Or a trust sale where somebody had passed away and it's a great home, great location, great everything, but you got wallpaper, you got older cabinets, you got older kitchen, so I want to know kind of what your tolerance is in terms of what types of property you're open to. These are some key questions that I would need to ask you so that we keep our eyes on that. And then in those situations, now 5 under may be even generous on your part. It may be better to come 10, 15K under, or even further than that based on, what our evaluation is. Does that make sense?
Yeah, totally.
Cool. So I hope, and thank you for just being upfront and honest and brave of just throwing these numbers out, because there's a lot to explain with it. And that's also where I'm hoping you can lean on us in certain situations, and typically it'll come out because we want you to write what you want to write. But sometimes, and I've heard agents say, a buyer's got to lose 2 or 3 typically before they figure it out. Well, sometimes that's not worth it, especially in terms of how the market's progressing. Because my dad would share a story that this guy, it was an old Navy guy, was just a negotiator. And so he came in low, the seller came here, then they came to here, then to here. They finally come within $1,000 of back and forth, which is back and forth, counter. While that's all happening, guess what happens? Offer comes from left field that comes in and now writes closer to what the asking price is. So over $1,000, the guy who ends up missed out on this property that had a swimming pool, that had a nice detached house, had all the things he wanted, he lost over $1,000 because of just pride and just like, nope, I'm gonna make the last shot and make the last call. While the back and forth is happening, another offer comes in, and that's very common to happen, especially in this market today. That's part of where we work on the expiration, because typically your offer is good for 3 days. It's 3 days, 72 hours, and then at 5 p.m. on the 3rd day it expires. Well, I don't like working that way. I like answers quick, and if we give them what they're looking for and we write a full price offer and we come in correct and you're qualified and you can get the job done and you're working with good professionals on the loan and the real estate, there's no reason why they shouldn't take our offer, right? So I'm going to do everything that I can to try to get them to commit to that offer, put the pressure on them. And some people don't like it. Some people don't like the pressure. So I can't say it works every time, but it does increase your probabilities. So just, without belaboring it, but it's key to understand that. So getting back to some key things to understand about the contract here. Your offer gets accepted. So let's just say you write at 485 and they counter you back and they counter you on a single counter offer. There's a difference between a single and a multiple counter offer. Your single counter offer means you're the only person that has an offer in. The second, so when they counter you, they reject. So you give them an offer. If they sign off on it, they're locked in. You're giving them the power to bind you to a contract. Now, vice versa. You send an offer to them at 485. They counter you back at 490, full price, right? On a single counter offer. That's still good news. You know why that's still good news?
Because they're asking the price, so they're like locking themselves into it.
Absolutely. You're already thinking ahead of it. You sign off on that and you deliver it to them, it's your house. So if you get a single counter back, lock it up, especially if it's $5,000, So say you tried 485, you just luckily got a counter back for $5,000 more in that situation. Most aren't going to do that. Most are going to wait till they got a second offer in hand. Because once they get the second offer in hand, guess where the leverage starts shifting? Starts shifting to the seller, right? Mm-hmm. So it's all case by case. Yes, market factors matter. And you'll hear it come up, and that's where the agents do a lot of barking back and forth. Oh no, you do realize what kind of market this is. This literally came up just yesterday from an agent that we're doing a final walkthrough, and I'm just trying to emphasize still the stress and everything that's going on in this particular transaction. And it's yeah, I do understand what kind of market it is, but no matter how you put it, doesn't mean that it's not overwhelming to our buyers. Doesn't mean that they don't still have valid concerns that need to be met through the process. But what that response is trying to, say to me, and I just watch Back to the Future, is McFly, right? Don't over negotiate your position in the wrong type of market, because they can get out if they send you what's called a notice of buyer to perform. So let me get to that real quick. Since I'm spending a lot of time up front, I normally don't get the chance to talk about the offer as much as we did. And I think for where we're at right now, that's a critical piece for us to understand is first getting qualified, then getting to looking at properties, then knowing the right type of property to write an offer on. And then when we write that offer, in essence, you have nothing to lose in terms of you put an offer together, there's no cost of what you're paying. We have a $200 processing fee. That's an admin fee. And that's just to digitally store all your paperwork for up to 5 years. That's a closing cost that comes in after you close the transaction. But up front, even though you'll sign a Veteran Home Services addendum that talks about that fee, it's not like you're paying $200 every time you write an offer. So just want to be upfront about that really when you write an offer, yes, it can be legally binding, but there's no sweat off your back that, the worst they can do is not respond to you. They could reject you, they could counter you, or they could accept it. So sometimes it's good. I'm not saying never do it just to try it out, but don't be afraid to do something like that, because we're going to have all these protections as I'm going to go over right now, the contingencies, because the purchase agreement, the offer is to protect you as a buyer. And that's how the offer is built, is to put the protections for you as a buyer, because seller, once they cash out, they're gone. They have a duty to disclose any material facts, anything that they know that should impact the value of the home. They have a duty to disclose that. Do all sellers do it? No. But they have a duty, they have an obligation to do it. We have this escrow period, our due diligence period, typically the first 17 days to investigate a property. When I say typically, that's what's customary on the contract. Now, in a multiple counter, don't be surprised if they shorten those windows down. The reason why they want to shorten those windows down is because, like I said, they're locked. They're stuck with you if they accept your offer. So other offers or other interested buyers come on the market. Typically in the first 2 weeks a house is on the market, that's the most activity that buyers are going to have or interest in a property. The second it flips to pending status, it cools off dramatically. So who do you think gets in a stronger negotiating position if there are no backup offers, if it's not a multiple offer situation? That buyer now in a single offer situation has more negotiating power the further we get down to that 17 days now, but we don't want to do it and drag our feet in bad faith. So what we're going to do up front, like I said, you have 17 days to investigate. Up front, day zero's offers accepted. So they send you a single counter back at 490. You're like, yes, that's what I wanted. I sign off on it. I send it back to them. The second I deliver it, they're bound. So even if they get a 500 all cash, hours later, they're stuck with you. The best they can do is take that as a backup offer. That's the best they can do. So that's the good news. Then you're in the driver's seat. You have 3 days to get your earnest money deposit in. Earnest money deposit, typically customary is about 3%. That's all negotiable. Everything in real estate is negotiable, biggest thing. So never hesitate in terms of asking a question in terms of, you know, do we have to do 3%? You don't have to, but this does show strength for you as a buyer. And you always have to kind of anticipate, especially for the good properties, that you're going to be competing with other buyers. So how do I make myself look better? Well, one of it is having a bigger earnest money deposit. Now, what you want to keep in mind with the earnest money deposit is you see it right here on the left side. It says EMD, earnest money deposit. Average is 3% of sales price. Can be used towards your down payment, your closing costs, or could even come back to you. There's a number that Jason will give you as he's estimating everything called your total cash to close. It's more than your down payment. That's everything encompassed in terms of fees, everything that you need to come in with to be able to get a house at a particular payment. So say you do 3%, and we're talking 500,000, right? $15,000. When you write that check for 15K, or you wire over the money for 15,000, it goes to escrow. Escrow has two meanings. So we talk about escrow timeline. You'll hear, oh, we're in escrow, or we have a 30-day escrow. That's in reference to the process and the timeline. That's one meaning of it. The other is the physical escrow company that is an office, a building, I guess could technically be virtual, but you have an escrow company. So you'll hear First American, you'll hear Fidelity, all these different, All Valley, all these different escrow companies. Well, that escrow officer is a neutral third party. They don't work for the seller or the buyer. They're kind of an intermediary that everybody will work with. They'll reach out to the loan officer. They'll reach out to the listing agent and the buyer's agent. That person is there to really kind of streamline the process. And then that earnest money deposit goes into an escrow account at escrow. And so seller doesn't get that money. So the good news is that 15K, just throwing 15,000 as an example, that could be used towards, say you need 25 in total to come in cash to close. Well, that's like your first payment towards it. So you want to make sure whatever your EMD is, that it's enough that you can handle still paying your bills, doing everything you need to do, because it's going to clear. And another big question that you want to bring up to Jason is they source funds. So your accounts become very important. This is also another reason why the quicker that your loan officer sees your account, sees your bank statements, looks at everything, they can start looking for what we call like skeletons in the closet. And that could be a large deposit. It's not always negative. It could be just a massive deposit. Say you kept $10,000 in a safe for many years, and this came up in a situation. And then it's like, oh, I'm going to buy a house. Let me put it in my bank account. Well, that account that already had, say, 20, 30K in it, and now I just put 10,000 cash into that account, it screws up how we could even use that account, because now the banks want to know where that $10,000 come from. So we have to source the money. So your earnest money deposit, depending on where you write that check from, becomes very important of which account did it come from, can you source it, right? And then there's gift money, there's other things like that. So anything money related, that's why it's critical. You got somebody like Jason, you call Jason up, hey, we're going to get some money as a gift. We're going to do this. It's called sourcing your funds. So these are all things that could jeopardize the deal that you don't even realize. You just got your offer accepted. You're excited. Now you say you got a gift from a friend or whoever, and they just put this money in an account. You're stoked. Now you find out, oh, we can't even close in 30 days now because we can't even use the money that we thought we originally were able to use. So just some key things, a little bit more complex than just talking about what an earnest money deposit is, but just I want it to be a red
good
flag.
points. Yeah.
Yeah, red flag, so that again we're coaching you through the process so that you got a nice end outcome there. So earnest money goes in. I'm sure the other agents that are on it is like, geez, you just get it going already. You're starting off the beginning, but this is key. All key information. Seller has 7 days now to get you disclosures. Okay, so the seller having 7 days to get you disclosures, they're going to send you a whole list of disclosures, but the two key ones we want to see is what's called the TDS, Transfer Disclosure Statement, and the SPQ, Seller Property Questionnaire. What those forms have are typically written out by the sellers of anything they know about the property that they're trying to disclose to you. And the SPQ is a little bit more detailed, the Seller Property Questionnaire, and that's to trigger things that people forget about on the Transfer Disclosure Statement. It's not always intentional that somebody forgets about a leak they had 10 years ago, 15 years ago, especially if you have an original owner. There's just things that get lost over time. So it's not always intentional, but this is the opportunity. If I'm representing a seller and I'm on the listing side, this is their opportunity to really CYA, to cover their end, so that they can show in writing that they disclose something that the buyer should want to know about. The nice thing is they do it up front in the first 7 days. You're always going to have, at a minimum, at least 5 days after you receive a disclosure. So you actually have 10 days here, from day 7 to day 17, to investigate everything they share with you. And then, so if they tell you there was a leak and you discovered, through your home inspection that you need to do a sewer lateral inspection, you still have time to investigate. So that's why we don't wait till day 17 to schedule our inspection or our appraisal. We're going to do that typically in the first 3 to 7 days. We're going to schedule your appraiser, your appraisal with an appraiser, and that works with where you'll give your credit card information to Jason if you were working with Jason. He's going to tell you, hey, I got everything I need. You've already signed your initial, I forget what it's called, it's intent or something of that. Jason, you still there?
Yeah, the intent to proceed.
Intent to proceed, right? So you get that sent to you. You can do that through e-signature, correct?
Yeah, it's sent out with the initial disclosures and the loan estimate.
Okay. So you get all that up front, and then when you do that, then is that typically when you ask for it after that signed for the credit card information to order a third-party appraisal?
I usually send out, once the disclosures are sent out or in the process of being sent out, I'll send an updated list of items that we need.
Okay.
I try to have all of my ducks in a row, but there's some things that there's no point to ask for, such as an insurance quote until we have the property, as well as the earnest money deposit. We need to get proof that the earnest money deposit clears, as well as the credit card, the credit card, the appraisal request, because it's specific to the property.
Okay. And ballpark, it's about roughly, what would you say, 550 to 650 is on average?
Yeah, I mean, so the standard turn time for an appraisal right now, not ordered on a rush, it's $500. But that's like a 10 to 12 day turn time.
10 to 12 day. Okay.
So we basically have to pay for, excuse me, we have to rush it every one now.
Right.
So it's usually like 550.
550 for a rush. That's not too bad.
No.
Okay. Yeah, I've seen 650 in the past. So these are out-of-pocket expenses, just to be aware of, Danielle, because on these, if you were to cancel and back out, you're going to get your earnest money deposit back. And a lot of people are even scared to tell you something like that. I'm going to tell you, because every single earnest money deposit, anytime a buyer is backed out, that's one thing that this is how we work, is if whether you move forward with the transaction or back out, we're always going to tell you your ways to get out of the contract. We're always going to share that with you. And I've had agents argue with me of why you would do that. And it's pretty plain and simple. Number one, we got a fiduciary duty to protect you and to try to help you in every way that we can. So what good does it do by keeping you in the dark in terms of knowing your ways out of a contract where, this is a major, huge commitment. The last thing we want is for you to feel obligated and move forward with something that your heart's not 100% in, so that's critical. So we're always going to share that with you. And then when you do it the right way and your contingency is your good faith excuse out of the contract, that's some of the things that are listed over here as you start seeing the appraisal, it's a contingency. The loan is a contingency. Termite can be a contingency if it's written into the contract or a condition to close the deal. It could be HOAs and CC&Rs as a contingency. So these are all different things that once you get it and you check it off and you say, hey, we removed this contingency, now you don't have that as a way out of the contract. And it starts coming up. Base 17 is typically your first big day that the appraisals do, as well as basically all your contingencies other than your loan. Your loan's at 21 days. So essentially you got 3 weeks in most situations to fully commit to a house, and sometimes longer than that. I mean, it's we're supposed to close on a property that I'm in escrow with. We just did the final walkthrough today. So we're probably at see day 25 on here. Within the last 5 days, you do your final walkthrough. We're supposed to close on Monday. we still have our loan contingency in place, and we still have our solar, because there's solar on this property. So we have 2 ways out of the contract still, and we're less than 5 days from closing. I just said at 21 days, all your contingencies are due. And you may ask, well, how's that even possible? It's possible because communication, speaking with the other agent and letting them know what's going on. Jason doing a lot of legwork on his end, communicating and being upfront, being transparent. Hey, we need a little bit more time. We're still waiting on solar. We're still waiting on this, whatever it is. And we tell them, hey, we need you to do these things. They needed to do termite clearance on this one because it's a VA, VA different type of loan, which requires Section 1 and Section 2 clearance for termite. Just so you know, termite's not an automatic thing. And it used to be in the past where everybody thought termite had to be done on every single transaction. So you'll have people who bought 10 years ago, 15 years ago, 20 years ago, saying, oh, no, absolutely, you have to get termite free and clear. That's not the case. We can negotiate it. We can do it during our investigation period, but it's not a mandatory. So that's important for you to understand, because that can also increase your chances to make sure that we close the transaction successfully. We can still negotiate the repair work. And sometimes it can be done prior to closing. Other times it's done outside of escrow. So you got a couple options there with termite, but that's something that's changed actually since 2014, because somebody got sued for basically saying that termite had to be done every time. They told the seller that, the listing agent did. And it was a huge major lawsuit in California. And you're talking like $80,000 in termite work on this property. That was, it was a Malibu beach property. So you can imagine high-end everything. But the agent actually told their client that it had to be done, which wasn't accurate. And once that person found out that it wasn't a mandatory thing, there's only 3 things that have to be fixed if you're buying in Ventura County: water heater, smoke detector, carbon monoxide detector. Water heater just needs double strapping. Smoke detector, carbon monoxide detector is pretty basic, pretty simple. But you know, if it's 2 levels, then you got to have one on each level. For the most part, they're saying smoke detectors in basically every bedroom, where before it was just one in the hallway. If it was upstairs, downstairs, one in the upstairs hallway, one in the downstairs, and the carbon monoxide detector. That's it. That's all that's required in terms of repairs. Everything else is negotiable. So I think it's, as you hear about this, you can see why it's so critically important to have somebody in your corner that you trust, understands the process, and is going to go to bat for you every step of the way through the process. And sometimes it's also important to know an agent. You don't want a bulldog that kind of gets the other side upset to an extent. You got to kind of know when to push and when to back off. Because as agents, if you push too hard and you're riding the other side the entire way through, you start creating this. And then when you create that, it's people aren't working together as much. Or say the demands are just too high on the repair request, where they were willing to work somewhere in this range, but you asked for all this. So now they're responsible for this, right? So it's understanding negotiation. And that's where, again, I'm hoping you lean on us. My wife thinks I'm crazy in terms of negotiation. I love the negotiation aspect of it.
I work in marketing and my dad works in sales, so I totally understand that.
Perfect. I love it. Love it. It drives her crazy. She's like, how do you sleep knowing that this is riding on this, approach? And it's just, when it works out, it's very gratifying. That's probably one of my favorite parts, in terms of the entire process, is the negotiation aspect. So we want our clients to be proud of what we get. We can't promise, we have to set proper expectations on every given market and every given situation. So just always ask those questions, and just know if we can push, we're going to push. But we also got to know not to over push or over negotiate. And that to me is a real skill in terms of being able to communicate that to ultimately get it is what you and Andrew are trying to accomplish. So does that sound good?
Yeah.
Cool. All right. So now we've gotten through most of the process, day 17, right? The day 21's on there for the loan. So what I'll do, and Jason, are you still there?
Yeah, I'm here.
Okay. On day 21, you know how the call goes. It's usually the one that I can tell is your favorite phone call to get. What happens around day 21?
You call me.
Right. What do I always say?
Contingencies are up. Where are we at?
Yep.
And, hopefully we, we have a clear to close or very close to it. So I can say we're good.
Right. And that's probably, in all frankness, probably one of the most uncomfortable conversations typically that you and I have through the process, right?
Yeah, I mean, it's always when everyone wants to know that the buyer is all in, because that's the last contingency out of the contract.
Right.
Ideally, we want to get everything cleared as fast as possible. Some lenders will give the okay to remove contingencies with a clean conditional approval. I personally do not, mainly because there's different parts of the process. There's usually one, sometimes two underwriters that underwrite the credit and the income and the assets and the appraisal. And then when you get them, so initially you'll get the conditional loan approval, and then the underwriter, even if we turn in a very clean file, there's always going to be something that the underwriter asks for. And so our job is, once we get the conditional approval, to get them all those somethings so they can give us the final approval. And sometimes one condition leads to another. So that's why we always want to make sure we turn in a clean file. But there's longer than we prefer turn times right now because of the low interest rates. Everyone's refinancing, and there's a lot of people buying homes. So lenders are, they have a backlog, for lack of better terms. And it's putting pressure on a lot of lenders to be able to hit the, have the clear to close. And some lenders can't even get the conditional approval on day 21.
Right.
But for me, I want to have everything in the underwriter's court, have them sign off on the file. And once they sign off on it, most lenders have a QC, quality control process, where they'll make sure that the underwriters did their job and they filled out the checklist and whatever correctly, and that nothing else popped up. It's pretty rare that something else pops up, but sometimes things can happen. And ultimately, I don't want to, be the one to say, yeah, Brandon, we're good. All that we needed was a, updated pay stub. Come to find out that, there's some sort of child support obligation that wasn't really detected. It was, it came up on the title, and it might have been missed by the underwriter and possibly the loan officer. Things happen. We're human. Mistakes are made. So ultimately, once we have the clear to close, there's no more looking at, from a credit qualifying standpoint. At that point, we're just working on getting the documents drawn up and sent out. We'll have prior to funding conditions, but it's going to be more closing related, like making sure that the remaining funds were wired into escrow, that the documents are signed, et cetera.
So those are the magic words, and good job explaining that. And it sounds complicated, and it is complicated. Biggest things we're waiting to hear. There's some final conditions, things that the underwriter needs. Jason's telling me, hey, we got to clear to close, or there's a couple conditions, but they're pretty minor conditions, just things I need to get from escrow to update this. I'm not concerned if you have to do it today, giving you my blessing. But just so you know, we're typically going to hold out as long as we can, and not to be difficult to the other side. And it puts a lot of pressure, because I'll be blunt. If I'm on the listing side, Jason's seen it plenty of times. He knows, because we've been on opposite ends of it as well, where he's representing the buyer and the listing agent. He knows I'm not going to let it slide in terms of people not committing when they're ready to commit. Now, I can't say I'm going to slam the hammer on day 21, but it's going to come, I'm not going to let it drag out, because then if something does happen, now if I'm working with Jason, you think, and he's probably, thinking this thing right now, like, gosh, well, why wouldn't you give me more slack, more trust? And it's not the lack of slack or trust. It's about what can happen. And so when you remove that final contingency, you're 100% completely committed to closing. And that can be scary, because now that earnest money deposit, say it's $15,000, could potentially be at risk. Now, it's not as simple as just somebody saying, okay, loan didn't work out. Now we put that $15K at risk. We just lost $15,000, and automatically that seller gets that money. It doesn't work that way. You'll see through the contract where it talks about mediation and arbitration. It also limits your damages in terms of your earnest money deposit. There's a liquidated damages clause, and we're not giving any legal advice, but there are things that limit your liability based on what your amount is. So on the good side, it shows you got strength. You're writing a big earnest money deposit. On the negative side, on the risk side, the higher that is, that's more potential you could put at risk, right? But again, knock on wood, we've never lost an earnest money deposit since 2004. And a lot of that is because we know the contract well, and we don't remove contingencies prematurely just to appease the other side. So Jason's seen plenty of emails that I've had with other agents, especially recently, where the other side is on me and they're demanding, and they're basically just saying everything but sending what a listing agent should do, send the notice fireable form. That's their one weapon they have. When they send the notice fireable form, that's something in writing that says, hey, you're past your 21 days. Here's your notice fireable form. If you don't perform in 48 hours, I guess what happens? Danielle, are you still there?
Yeah. You lose everything?
Don't lose everything. But what it does is those doors were all shut for the seller. Just imagine that hallway with 10 doors open. Buyer can walk out of any of those 10 doors at any point in time through the process until you start removing those contingencies. Then you shut the doors, right? You shut all the doors. Now, let's say that you shut all the doors but one, it's the loan. And the other side is like, you know what, screw it, I've heard already too many excuses. I need to send that notice buyer to perform, right? Say they're at day 21. They could actually send it as early as day 19. They can do it 2 days prior. Haven't seen it done, but by the contract, they could actually send it 2 days before that contingency is due. Never happens, so customary, custom, you don't see that. But say they send you on day 22 that 48-hour notice. Now, if you still don't remove that loan contingency within those 48 hours, now that door is open for the seller, and the seller has a right to cancel. Doesn't mean they will cancel, but they have the right to cancel. Now, if they cancel and you haven't removed your loan contingency and the seller wants to cancel, the good news is they can't just take your earnest money deposit. It's not an automatic. They're actually saying when they cancel that, they're giving you that earnest money deposit back. So it's not like they can cancel and take your money, right? Because you kept that way out. So you had a good faith excuse out of that contract. So without confusing you too much or stressing you out about the notice buyer perform or contingency removal, just know we do everything in our power to make sure we do everything up front, negotiate, know exactly what we're getting before we get to that time of, okay, are we 100% committed or not? When we do, it's an active contract. Nothing happens automatically. We have to take action before we fully remove those contingencies. And there are some situations that we've been able to close them without removing all our contingencies. Typically, it's most of them in most situations. And when I say most, I'll say all but the loan or all but one or two things. So, if there's a way, believe we know the ways to make sure that you're protected. And then, and that's also when we talk about the seller duty in 7 days. If the other agent's not on their game and they don't give me disclosures in 7 days, I mean, I could hound them. And sometimes we'll ask them once, if twice. But if there's one thing that they didn't fill out correctly, they didn't fill out all their disclosures with their explanations, then if I ask them that question on day 20 and they finally correct that disclosure or send it to us, what did I say earlier about a late disclosure? Do you remember how many days you have to review that?
10 days?
5 days. 10 days is a good guess, though. 10 is because of the 7 to 17. That should be the difference. But if you get a late disclosure, so say they were supposed to get us a termite report, it was written in, and they didn't get us the termite report till day 16. Now we have 5 days to review that late disclosure before removing that way out. So if they sent us a notice buyer to perform, it'd actually be invalid. It'd be avoidable. It wouldn't be legit because they didn't do what they were supposed to do and get us all our disclosures within the first 7 days. So
Totally
sometimes
understand,
strategically, even though we see a mistake and we'll typically call them on it, sometimes we'll leave one way towards the end before we ask them that question because it's not our job to do their job, right? It's not our job to show them everything. My job is to protect you. And if I create an out that's still there towards the end, again, I'm not going to just like strategically every time, I'm going to wait till day 20 and really stick it to them, right? That's not the way we want to work. But if I have something like that, that may be why I'm saying, hey, let's not worry about that explanation right now. They're supposed to get that to us, but we will ask it at some point, and that could buy us a little bit more time if I need to do it. So just, I hate to get into those kind of details of it, but there's certain things to know about because none of this should feel rushed. And I think that's the biggest thing that, coming from law school, and this is, again, I'm not giving legal advice. Everything through real estate is about getting proper disclosure, getting things in writing, having it in writing, and then having enough time to see it, investigate it, and then do what we need to do and make our decision whether we move forward or ask for something or back out. And the one thing, there are two things I didn't touch on that I'm going to touch on real quick. Are you still doing okay on time? I know we're getting close to it.
I actually have another call at 6:25, but I told him I can do 6:30.
Okay, so you got to
I was
get up.
hoping.
So you got
Yeah,
time.
sorry.
No worries. Well, we're going to wrap it up. I'm sure everybody else is thanking you for saying. And I hope, has this been helpful so far?
Yes, very helpful. Very helpful. Thank you.
Awesome. Well, any other questions, I guess, before I jump into my final 2 points for you?
You've covered a lot of information, so I think I'm good right now.
Awesome. So just the last two, and I'll try to do them as quick as I can. Appraisal. So appraisal, when that comes in, if it comes in less than value, you as the buyer own that appraisal report. So if it comes in over value, so say you got it at 490, right? But it came in at 480, 480,000. We got a $10,000 difference. There's three things that can happen. We could either use it as our way out of the contract. We can ask them to drop the price to 480. We can ask them to drop the price and they try to meet us in the middle somewhere. Or, you know, like I said, we could just walk away. Or I'm sorry, the last one is you just cover the difference. If they say, look, we're in this kind of market, we'll get 490. That was a bad appraisal. You're covering the difference. Then we're just covering the difference. So those are the things that can happen with an appraisal. Does that make sense?
Yeah.
Okay. The other thing is on the request for repairs. So as we do our investigations, we do our home inspection. I put 350 to 450. I'd say it's probably closer to 400 on most properties, right? But based on the size, townhouse versus detached, it's going to range for that. So your appraisal, we just said it's about 450. Home inspection, let's just say 450. That's $900. So that's your out of pocket. Now there could be more inspections. Your home is a general inspection where they're going to check the attic, they're going to check plumbing, they're going to check all your basic things that you're going to see in a house. It's kind of jack of all trades, master of none. So they know enough to point out the red flags. Now, if we see a plumbing issue, we're going to send a plumber in there. That's why we want to do the inspection up front. And then depending on what we put together, I already told you what had to be fixed by law: water heater, smoke detector, carbon monoxide. Everything else is negotiable. But typically, we're going to put a request for repairs together, especially if we have no backup offers. It wasn't a multiple offer situation. But even if we have that, we're still going to put a request for repairs together, try to keep it more towards safety items, not cosmetic, because you're going to have a higher likelihood of getting the safety items corrected. Okay, that's just based off experience. So we put that together. They have no duty to respond to our request for repairs. It's not one of the contingencies on here.
Mm-hmm.
That's just an option for us to ask, and it's an option for them to respond. Customarily, most will respond in a timely manner on that. And most agents, ironically, don't even understand that there isn't a mandate. That was like the most common question came up. How much time do they have to respond to us on the request for repairs? How much time? Like, agents that have been doing this for a long time bring that question up. It doesn't say it anywhere in the disclosures or the contract or anything. And the reason why is they don't have to respond. They don't even have to respond to it. So we can't like just try to wait towards the end and say, well, you didn't respond, so I'm not removing my contingencies. We can talk about it, but there's nothing contractually that obligates them to. But I'd say, I think in every situation, we've at least gotten some type of response. Customarily, that's a common thing. So does that make sense on those?
Yeah, that I never knew about the whole, like, only required for the three of them with the water, smoke detector, and carbon monoxide, because,
Yep.
yeah, that's a common thing of the termites.
Yep. Termite, yeah.
My parents, that's something that we've talked about with our parents and, like, them selling in the future and stuff like that.
Right. It's not a mandatory. And see, in terms of them selling, this would just be a final point. It's timing of the market. Low inventory time like now, termite isn't a mandatory thing. Now, some agents will say, oh, you got to do termites automatically. Anytime they have a report or do any type of investigation, they have a duty to disclose that. So if you get the wrong termite guy to go out there and he's just trying to get a tent job, and 9 times out of 10, they're going to say, oh, tent's needed, tent's needed, tent's needed. One situation I saw, it was like $200 in spot treatment, just a little bit in the attic, and he still put a brand new tent was needed at almost $2,000. That's just their kind of common practice. Well, the downside is once you have that report, you as a seller have a duty to disclose that. So now you have to try to explain to the next buyer that, oh, I got somebody else to do it for $200 for spot treatment, yet this other termite company said, I need a full tent. And then so now they start questioning the second one who did it for $200. That makes sense.
That makes sense. Yeah.
Little things, but I know you got to go. So thank you for your time.
Thank you.
Yeah,
this has been very helpful.
Awesome. Well, I hope it's a good start. And as you know, we can set up, this is why I really wanted to emphasize us doing a one-on-one, which has kind of turned into that, which I'm grateful for, because I can tailor it specifically to what we're talking about right now. But if there's anything else that you and Andrew would like to do, we'll set up another time. We can set 30 minutes to an hour and really just kind of anything that's come up from this meeting, hammering those situations. And
I'll talk to him later about all of this that I've learned, and then we'll kind of talk to you about it afterwards.
Awesome. All right. Well, you have a great one. Thank you again for your time. And then I'll just check in with everybody else before we wrap up.
Perfect. Thank you.
Cool. All right. Take care, Danielle.
Bye.
All right. Bye-bye. Okay. How's everybody else doing?
Good.
Good, I got Yvette.
Yeah, I had to unmute myself.
Anybody else snoring on the other side there?
Nope, I was listening.
Okay, cool. All right, I'll